Hey everyone, welcome back to the Tuesday evening financial thing, May the 3rd live stream. We're talking a lot about REITs tonight, real estate investment trusts. We'll look at some of the UK REITs that are available, some of the US REITs, and kind of look at the performance and see how these REITs have done over quite a long period of time. We'll see how they stack up against some other different investments, particularly index trackers. See if it's a good investment or not. The numbers never lie. History is history. Cannot predict the future, but we can only look at the historical numbers, and I think it's quite interesting. REITs have never been something I've invested in personally, so I'm somewhat green to them, but they're pretty easy to understand, so we're going to go through those. Talk a little bit of crypto news today, see what's going on in the economy and the stock market. A few interesting tweets I think are important to pay attention to. And, what's going on with the stock market. Things are looking very frothy. Very frothy. So I think for me personally, I'm looking at the benefits of maybe some cash positions. The trading 212 portfolio is now, for the most part, heavily in cash. Think about 30% now equities, 60% cash, something like that. I see troubled times ahead in the stock market, and just kind of a question of not if, but when this pullback happens. And protection of capital is really important when it comes to investing. And now if you're a long-term investor, don't change a thing. Don't change a thing. But, if you're somebody that likes to try to find opportunities, then there could be some changes to be made. Anyway, hope you're having a great week. It is Tuesday. It feels like it should be Thursday or Friday, but it's not. It is Tuesday today. And let's we're gonna crack into it. If you can hit the thumbs up, that would be really appreciated. And if you're tuning in the future and not live, welcome to the stream. Hope you are doing well wherever you are in the world. I'm a little bit discombobulated today, so if my thoughts do not necessarily come easily, you'll know why. Sometimes we go through these ups and downs in life. Sometimes life throws you a curveball that you're not expecting, and I think curveballs don't get any easier as you get older, at least for me. So I'm trying to maintain balance, maintain my chi, the serenity of life. So anyway, let's see who's tuning in tonight, and we're going to get right into all of the juicy bits of information that I think you're going to really enjoy this week. Paul New is here in Stockport. Aki Chap, of course, in Accrington. Alan Duffy is in Scotland. Been working on my Scottish accent for you, Alan. Scotland, haggis, Edinburgh. How was that? Peter Vincent Leatherhead. Mike is here in High. I'm presuming Southampton as always. Brian is in Woburn. Paul Bagworth is here. And George Batchelor from Bridlington. I have no idea what Bridlington is. It sounds like a very cute place, Bridlington. Okay, we're going to get right into it. We got a lot to get through tonight. In my discombobulated state. If you've ever been discombobulated, I'm sure you can understand what it's like. You're like, man, my brain, I wish it would just form a coherent pattern. Let's take a quick look at the Trading 212 portfolio and see where we are today. Big changes today. Big changes. Here we go. Look at this. We're sitting on a portfolio right now, £17,226. Yesterday, that was looking a lot worse. It was, I think, about 16,500. And today you can see that invested-wise, there is only 5,200 pounds invested. That's because I have reduced all of the positions down in this portfolio, except for this clean spark stinkeroonie, which is already down 50%. I didn't really see any purpose other than maybe for a tax write-off to liquidate this. I'm just going to keep it for now, but you can see here pretty much everything has been reduced way down. So profit taking, there's never wrong to take profits when it comes to stocks. Some of these stocks have done really well, like Occidental up 118%, Vermilion up 49%, Flex up 57%. So everything looking pretty good. So if I look at this, show you the notifications, here you can see all of the executed orders today and pretty much everything, including a complete liquidation of BHP, which I bought just a few days ago. And, you know, there's several reasons why I did this. I think timing the market is extremely difficult, but all of the indicators, in my opinion, are pointing towards that maybe this coming, I think it's this week, whenever the Federal Reserve announcement is in the US, with what we all presume is going to be an interest rate rise. I don't know that the stock market is going to take that well, and things just don't feel particularly stable right now, especially with what happened on Friday, which was really a rough day in the stock market. We saw this big Amazon drop. If we look over the last week, right here, from 2,900 all the way down to 2,400, and that's a big deal because Amazon is one of the biggest stocks. We've seen 11% drop, which is a very, very large drop for Amazon. They reported a substantial loss. I think it was about $8 billion. That doesn't pose well for what we think is going on in the economy. These are the indicators that we look for, right? We hear these signs, but rising interest rates, high inflation. This is not just in the US. This is happening in a lot of countries. And then we see a stock like Amazon post reports of their earnings being poor. And it's kind of like the writing's on the wall, right? The earnings are not good. That's a big loss, $8 billion. I think it was $3 billion profit the same quarter of last year in 2021. Obviously, Amazon has seen some big increases in their revenue because of the vid virus and people staying at home buying more things. But that's a massive drop-off. You're talking about $11 billion swing. And the market, of course, reacted very negatively last week. The S&P falling severely. Some of the oil stocks actually just getting battered. The entire market, I think we were down 3% on Friday. And it just looks like there is a lot of uncertainty with what's going on. We have, let's see here. That's not what I'm looking for. We've got some illiquidity issues here with the Federal Reserve in the US. They've got all these bonds that they're not buying anymore. And not only are they having trouble probably trying to find a buyer to buy the bonds that they already own, but also liquidity has gone down with, these bonds they don't have homes to go to anymore. So you got these treasury yield spikes, falling liquidity in the US. It's never a good sign for the stock market when you have falling liquidity in the bond market. This just goes back to the Federal Reserve propping up many things that I think they are starting to regret that they probably ever did, and we're going to see the downfall of that. You can see these treasury market values increase here, becoming quite volatile, and 10-year treasuries are increasing. Let's see what the US 10-year treasury is right now. It's been rising. Yeah, I mean, we're broaching 3%. You can see this is really starting to increase. So all of that going on, we have in the US manufacturing, the numbers came out, I think it was yesterday or today, that US manufacturing activity is slowest in more than a year and a half. Workforce issues, people quitting. The manufacturing index is down to 55.1, so that shows slowdown in the economy indication. We also have gross domestic product numbers that came out for first quarter of 2022. Again, I always use the US as an example because I think it's the barometer of what is going to happen, to the rest of certain first world countries with this slowdown. But you can see here, look at that little red blip on the right side, quarter one 2022, a negative 0.5% decrease in the gross domestic product, which estimates were 1.4% in the plus, so a 1.9% swing. That's not good news. That means things are slowing down with the economy. We have the GDP in the UK looking really stagnant. Gross domestic product grew by 0.1% in February 2022, which is down from 0.8% in January 2022. So again, this is happening not only in the US but in the UK. You can see these GDP numbers here. Obviously not as bad as in July of 2020, but we're not seeing really great numbers, and you're going to see these numbers start to decrease in the UK as well. Obviously, this is going to affect the stock market and other factors too, if you factoring a rising interest rate, things like that. This is one of the biggest banks in the US, Bank of America. Now, in the US, mortgages have longer fixed rate terms. So you can see starting from a 5-year variable interest rate, which is still low, which is very common in the UK, 3.5599%. But most Americans tend to go with these fixed mortgages of 30 years. That's kind of a standard issue mortgage in the US. You can see the rate here, the APR at 5.4%, which is, it's gone up crazy amounts from just a few months ago when you could get 30-year fixed rate mortgages in the 2.5% range. So we almost double. You'll see these monthly payments start to increase, which is going to put a slowdown on the economy. Here, this story, with an aggressive Fed rate hike expected next week, stocks and crypto markets lose billions. That's people again afraid of what this interest rate is going to be. They're predicting a 0.5% base point hike. 50 base points. It's 0.5%, and a quantitative easing tightening announcement. Try saying that after you've had a few Guinnesses. But that is, I think that's going to upset the stock market, and I think this may not be the end of it, and it could be more than a 50 base point hike. The Federal Reserve Chair Jerome Powell has changed his mind many times about what he feels is the right thing to do with interest rates, and this is going to trickle into the UK too. As it affects the stock market, everything runs downhill with the water. And who knows if it's going to be a 50 basis point, maybe it's 75 or even 100. We don't know. We don't know what they're going to do, but it's certainly going to possibly make for shaky times in the stock market. If we look at this tweet right here from Charlie Bilello, this is the worst months for the NASDAQ. From heights to, worst to the least, worst to pretty worst too. Down here, he gives April 2022, we had a minus 13.3% drop in the NASDAQ. You've seen tech stocks absolutely getting hammered. But none of these dates are good. We got 1987, of course, was a terrible time. November 2000 was the dot-com bubble. 2008, of course, the housing market crisis and the banks crumbling, was minus 17.4%. Some other September 2001, of course, 9/11 time. And then we have April 2022, and this is concerning right here, because the last time we had a major drop in the NASDAQ was March 2021 of minus 14%. Well, we had March of 2020, of course. But when you start seeing these numbers on this list, it's always a again, a red flag, warning sign. This was an interesting tweet. The Fed is going to tighten monetary policy until something breaks. Something like treasury market liquidity or credit market liquidity. Being defensive makes sense until a pivot occurs, a diverse mix of cash, gold, and defensive value equities. Again, I don't recommend anybody who's a long-term investor starts trying to time the market at all, but I think this is pretty good advice if you are somebody who likes to pick stocks and veer away from the index trackers, which I think is always the best way for 95% of investors out there. But you can see this is the ISM Purchasing Managers Index. It's just not doing very well, starting to drop down and fall away. So all signs are pointing that, at least for me, I'm thinking that a cash position, while I don't know what is going to happen from week to week, the markets certainly rally once we get these US Fed numbers and the interest rate increase. The stock market certainly take off. Who knows? But there's never anything wrong with taking profits sitting in cash and waiting for the things to kind of smooth out a little bit before making any decisions. So that was the reason why, I decided to take this cash position, not only in this portfolio, but also in some others that I own. But however, I've not touched my index trackers at all. Those remain fully invested, staying the course, because again, I could be completely wrong about this and the markets could just brush this off and just continue to really climb higher. I just really have no idea. I mean, we've had some big days on the market today. If you just look at this one stock, International Seaways, in the last week, it's up 6%. Today went from $20. I think we had a 10% increase. I'm not sure why this is saying 3.65%. But yeah, some of the stocks have done well today. Of course, this happened immediately after I sold. Everything started to rally 3%. I wonder if this is... Oh, no, this is yes. Okay. So, no, this should... let's see. Monday. Yeah, from 70 up to 73 for Laredo. So, you can never get this timing right. I've never been able to, but I just take my best guess of what I think is going to happen. Worst comes to the worst, I'm wrong about this. The markets continue to go up. Can always re-enter the market with those profits locked in. Not the end of the world. Let's take a look at REITs. I know a couple of people have said, hey, what about REITs? Real Estate Investment Trust. This was posted on the Financial Think Facebook forum. I can't remember who posted it, but thank you for posting it. It's a basic article explaining what REITs are, Real Estate Investment Trust. Basically, companies out there will put together real estate funds and trusts, buy different things, like could be hotels, land, residential, commercial property, and they put them in these baskets, and then they take the trust public on the stock exchanges, and it gives investors a way to have access to real estate investments without having to own the entire real estate block. It's a good thing because one of the biggest problems with property is liquidity, right? So if you own a piece of real estate, you want to get rid of it quickly, within a few hours or a day. That's very difficult real estate. REITs, you can sell them like a stock. If there is a buyer out there and you want to sell your shares, REITs are a good way to do that. You just pop them up on the stock market platform, whatever you're trading through, and then you can sell them. Also, if you're somebody that owns property with other people, like you might have a partnership of 2 or 3 people that own a building, and one of you decides, well, I think I want to sell out. Well, it becomes a problem then, because you got to find somebody to either buy you out your share, and that's not always easy, or the property has to be sold. So liquidity within owning property in groups of people is very tricky sometimes, unless one of the other owners can buy you out, which sometimes can or cannot happen. So these REITs do provide benefits of exposure to real estate through things like retail stores, office buildings, apartment blocks, and then you being able to buy shares. And we see this has been poorly attempted in peer-to-peer lending, where companies like Property Partner, who offer shares, and they'll buy buildings and sell them as shares. It's kind of like a real estate investment trust, just a little bit different. Fortunately, not executed very well in the peer-to-peer space, but REITs are an old school way of doing it. Has liquidity benefits, has some taxation benefits in the fact that REITs have to pay out dividends. Otherwise, they have to pay tax on that income that is derived. So what they do says they're also required to distribute 90% of rental income as dividends to avoid paying corporation tax, and then 20% of that amount that is paid out in dividends is held back to pay taxes. So REITs are a really interesting way to get exposure. The big question is, how these REITs performed over the years if we stack them up against some other investment forms, and even the REITs together. This is always the biggest issue when it comes to picking out investments. And REITs are no different. How do you pick the one that is going to perform the way you think it is? Some do well, some do not do well. Not all REITs are successful. Let me show you. This is on the London Stock Exchange. We're going to look at the the UK REITs first. So this is a list of REITs. There's about 50 or more of them that you can pick from. And some big names on here like BMO, British Land Company, Schroeder, which is, Schroeder has a lot of investment projects. But to be honest with you, I don't know anything about any of these REITs because I do not invest in REITs myself. But there's a lot to pick from. So you as an investor, you have to be savvy. You have to do your research, and you got to try to figure out which one of these REITs is going to be the one that performs well. So for example, if we look at this Schroeder Real Estate Investment Trust, which today is down 1.22%, you can go to the londonstockexchange.com and find out information about any of these REITs. So we'll look at this one. It's got a pretty good one-year return of 25.5%. Year-to-date, 4.86%, which is pretty good considering the markets have been pretty poo-poo at the moment. So we got Schroeder. So what I did is I just picked a few of these off of here and then went to Yahoo Finance and plugged them in just to look at their charts and to see how they've performed over the years. I don't know anything about these REITs. I just happened to grab a few that I thought maybe would be interesting to look at. So I took Schroeder Real Estate Investment Trust Limited. I picked the UK Commercial Property REIT, which is a pretty decent return, 16.87 for year to date, and a one-year return of 8.58%. Then the British Land Company, that has not fared so well, minus 4.37% year to date and minus 2% for the one-year return. And I picked this BMO Real Estate Investment Limited. This one has done 23% for a one-year return, 12% year to date. So three that have performed well, and three that have performed well, one that hasn't done so good. So I plugged them all into a chart for you through the powers of technology. I hope you can see that. This is a chart of performance. And what I also plugged in here was Vanguard has a real estate ETF called the VNQ, which is a real estate ETF that's made up of, let me show you what it's made up of. This is a passive way of investing for anybody that does not want to try to pick out a trust themselves or REIT. We can see here, where is the portfolio? It's got 164 stocks in it with a market cap of mid $26, $27 billion. This is what it has in there. Diversified real estate activities. It has REITs in there. It has healthcare REITs, hotel and resort REITs, industrial REITs, office, real estate development. So it's a basket of all these different things. and it tries to pretty much follow the MSCI US Real Estate Index. So what I wanted to do, I mean, you can see here too, this is the largest holdings here, top 10. Vanguard Real Estate 2 Index Fund is the biggest holding. Prologis, American Tower Corp, Public Storage, Realty Income Corporation. Again, I don't personally know anything about these, but let's put them in and let's look at the chart. Hope this is, see. Just gonna see if I can take my camera off for you. So my big head is not blocking. Hang on 1 second. Whatever. I'll just show it to you anyway. So you can see here, these are the different funds that I plugged in. Okay, SREI.L, which I'm presuming is Schroeder. Yeah, this is the Schroeder fund. You can see here, this is the blue line, right? Right down here, which if we look at what has been the best performing fund, it looks like it's a little bit sensitive here, but this dates back to 2004, where I'm presuming some of these funds, or maybe the data goes back to them. Maybe it goes back further, but I think 18 years is a pretty decent amount of time. So what we're seeing here was this purple one here is the Vanguard VNQ, which is the Vanguard ETF. You can see it's performed better than all of these other REITs right here. Now, again, this doesn't factor in dividends. I know that some of these companies pay bigger dividends than others, so I'm just looking at purely the price of the share, because in its most basic form, that's the easiest thing to understand. You can do calculations to include dividends, but it takes, it's pretty complicated, and I didn't have the time to do that. So I'm just looking at the share price. Let's look at the worst performer here. It was actually the Schroeder one, which has come down all the way from the 140s down to, I mean, basically you see here it's lost 45.17% since 2004. And then we got this blend, which one is that? Is that the BLMO? No, that's BRI. I think that's British Land Corporation. This one, right? British Land Company PLC, which was flying really high back here in 2006 when obviously the property market was doing well, and then took this massive crash, of course, as anything to do with property did at the time. Recovered a little bit and then has just really struggled. So that's negative 16.33% if we, again, look back throughout this charting from 2004. Again, this all assumes if you were to buy in 2004 on this date, which of course is never the perfect way, but we have to look at data points like that. And you can see these REITs here have just kind of all middled around these areas, sort of following each other a little bit. We've got this BREI, that's the BMO Real Estate Investment Limited, and then the other one is the UK Commercial Property REIT, that is UKCM. So here we can see UKCM is the dark line here, which is 7.6% in the plus. So by far, judging by this chart, the Vanguard ETF has once again shown that it can absolutely outperform over the long run. Passive investing, index trackers, very low fee ETF. We'll look at the fee here, 0.12%. So extremely low fee on the ETF, and that plays into why these passive investing funds tend to do better than these REITs. The REITs fees are high. You do also get dividends on the Vanguard product. It's not going to be maybe as high as some of the other REITs. I think it's a couple of percent. See what the dividend pays out. Show me the dividend. Why did you not show me the dividend? I think it's a couple of percent. Where is it? I can't find it. Right? Oh, here you go. SEC yield. Let's see what it says about it. Current adjusted effective yield is 2.56% as of March 31st, 2022. That's the unadjusted effective yield, and the adjusted effective yield is 1.67%. So they've got different ways of calculating that. I don't really want to get into the difference between unadjusted and adjusted, but this is what you're going to get is the 1.67, I believe. But still, the charts don't lie, showing here if you were to buy in exactly the same time, you would have seen this British land company absolutely outperform during certain times. It goes back to what we already know about index trackers, that over a very long period of time, if you just buy and hold, passive investing generally tends to outrun anything managed, and this chart again shows us that to be true. Again, big problem, how do you pick out which one of these 50 is going to perform consistently over 15, 20 years? You don't know. Some might do well for a few years and then fall off, and vice versa. You're going to never have to worry about that if you just buy an ETF that passively invests in a basket of different things. Let's take a look at what do we have here. This is the VNQ compared to, this is some US ones, since not everybody I know is, I don't know if I can zoom in any further, but I wanted to see if this was true also for the US REITs, because I know we got some people out there investing in US REITs. So I found this article that said 7 best REITs to buy. This was in Money magazine, and you can see here they've got the real estate, the VNQ, they got Charles Schwab, iShares, and then Vanguard Global X. This is a global real estate tracker through Vanguard, and I just wanted to again plug a few of these in just to see how they were doing versus the Vanguard passive fund. And you can see here, now this is interesting, I also put VTI in here, which is Vanguard's total market. So that's the equivalent of the Vanguard US equity index tracker. I wanted to plug it in and just see how the REITs were doing compared to that. So let's see, where is our VNQI? I think that's the, okay. So REM is the iShares Mortgage Real Estate Capped Fund. So once again, managed, that is a managed fund. And you can see right down here, this has performed really badly. We're at minus 50%. If we go back to, I think, where is this going from? I'm afraid if I put in max, it might screw the chart up. Let's try it. Okay, there you go. This is the max chart going back from 2005. Some of these funds might not have existed back then, but if we look back as far as we can, you see GEM is at negative 76%. We have VNQI, which I believe is, that's the Vanguard Global Index, which is at 3.9%. Not so good. We've got CHH, which is Charles Schwab, big investment company in the US. So SCHH up about 100%, so pretty good. And the blue line right here is VNQ. So that would be the Vanguard Real Estate Index Fund, the one we were comparing to before, which is 62%. So that one has underperformed the Schwab managed fund. But then up here, the real winner again, look at this, VTI, the Vanguard Equity Index Tracker, which is outperformed massively. I mean, double of what Charles Schwab has performed. Looking back to 2005, that's a big increase. 283% versus 100%. I mean, 100% is not bad, right? But 283% is better. So again, you're not going to get the dividend out of the VTI like you will out of the REIT. You're going to probably get higher dividend. But you can see here that the performance has just not been as good over the history. And I think if we went back even further, we would see the same thing over a very long period of time. These passive index trackers just tend to do well. I think the Charles Schwab situation is a little bit unusual. Oh, actually, I'm reading this chart wrong. You can see here, VNQ was behind Schwab at one point and then completely leveled out to almost identical 100% return. So Vanguard did not fall behind Schwab for too long. It did for a little while here, not even that much. But again, would you like to bet on you picking out the right REIT fund and, hoping that you're right about that? Because as you can see, this one down here is the wrong REIT fund and has done really poorly. Again, the dangers of trying to pick out these managed funds. So I think it was a really interesting thing to look at. And, if real estate is something that you want to have in your portfolio, then having a portion in a REIT is not necessarily a bad thing. But the chart's not looking particularly wonderful in the US or the UK. Personally, I'd rather just have my money in a equity tracker and take my chances with that. And now think about this too. If the housing market does slow down, which inevitably it's going to, these rising interest rates have to slow down the market. These REITs are going to inevitably perform worse because commercial property, when interest rates rise, money is going to become more expensive in commercial spaces. Putting a slowdown on there, REITs, of course, that are commercial REITs are going to probably do poorly. And same with the residential REITs too. People slow down, they stop buying houses because the interest rates are more expensive. Mortgages are more expensive. The REITs are going to perform worse. So that's a good look at REITs. Again, you can delve deeper into these things and look into them more closely. I'm sure there's some REITs that have probably outperformed our trusty Vanguard ETFs and stuff, but I don't know what they are. And then I don't know that they will in the future. There's no guarantee in the future that one is going to do better than another. The Vanguard may underperform a REIT. I have no idea. Crystal ball never works correctly. But I tend to prefer to go with what I think historically I can safely say is going to perform, and that would be probably an index tracker equity fund. So there you go. Let me know what you think, what your thoughts are. I'm sure maybe some of you own REITs. Some of you have found some diamond in the rough REITs that have performed really well. I don't know. Let's look at some crypto news, since that's what we do on a Tuesday. Bitcoin has been the red-headed stepchild. Is just really kind of bumbling around. Right now we're looking at the price of $37,757 US, which, hey, another great buying opportunity. Said this last week. I like to see these prices in the 30s because it's a great time to pick up some Bitcoin if you are a believer in that, which I am. Now, what I will say is Bitcoin has done very well over the last 7 days. It's dropped, obviously. But if we look at when this market drop happened on Friday, which was the end of April, we didn't see Bitcoin take a massive poo, which we've seen in the past where it could go down 10, 15%. Maybe that coupling to the stock market has softened, and we've kind of see it holding its own here with these stock market troubles, which is really nice to see. So whether that will continue, that's anybody's guess, but it seems to be holding steady around this $37,500 up to $39,000 range. I was expecting Bitcoin would have taken a big, huge poo on Friday when the stock markets did, but alas, it did not. So it's pretty cool. For any of you football fans out there, FIFA has announced a partnership with blockchain innovator Algorand, which I find to be very interesting. This is quite a high-profile announcement, and Algorand is going to help FIFA by further developing its digital assets strategy, while FIFA will provide sponsorship assets, including advertising, media exposure, and promotional opportunities. The FIFA president, Gianni Infantino, is delighted to announce this partnership, and it's a clear indication that FIFA's commitment to continually seeking innovative channels for sustainable revenue growth and for further investment back into football, ensuring transparency to their stakeholders and worldwide fans, blah, blah, blah. Probably Algorand paid him a lot of money to advertise, but it is a good partnership. It brings blockchain to the world in the forefront. He's a tall guy. I don't know which one is which. Does anybody know who the guy on the left is and who the guy on the right was? I bet this is, if I had to take a guess, the guy on the right is the guy on the left is the FIFA president. I think so. So yeah, a bit of bullish news, and we got some bad sort of news about El Salvador and how their Bitcoin experiment has not gained the type of traction as locals continue to trust cash more than cryptocurrency. A new survey found that most people in El Salvador are still using dollars even after Bitcoin was made legal tender. Most of the Bitcoin wallet downloads came as Bitcoin was made legal tender last year. Almost no one has downloaded it in 2022. And the survey concluded that only 5% of all sales were done in Bitcoin. Not a shock, to be honest. We're talking about, a country where probably the education of finance is not particularly high, and bringing in a new technology like this, Bitcoin's hard enough to understand for average folk. So I'm not saying anything bad about El Salvadorians. I'm sure it's a wonderful country, but I didn't expect that the whole country was all of a sudden going to be using Bitcoin to pay for things. I mean, that sounds a little silly. It's going to take a lot of education for that type of adoption to become mainstream. So obviously, maybe not so well thought out with the education side. Another article here. Bitcoin bond sale has flopped. El Salvador was planning to sell $1 billion of Bitcoin-backed bonds, and they haven't been able to do that. I don't think they've been able to sell any of them, and they have an $800 million bond that is coming due in January 2023. Some people are saying that they will not be able to make good on that bond, and so far so bad. I think this comes a lot to do with the International Monetary Fund, the IMF, not being very supportive of El Salvador, putting the kibosh on the Bitcoin, saying it was a stupid thing that they did. They should never have done it. So these bonds definitely not being particularly popular. Another news, look at this. On Wikipedia, Central African Republic listed its official Bitcoin currency. Right here you can see currency Bitcoin. So the Central African Republic now has Bitcoin as one of their central currencies. I think the first of many to come. Let's see what else is in the news. Oh, this is interesting. So ARK Investments, Kathy Wood, put out a report showing how many Bitcoin settled transactions there were in 2021. Look at this, $13.1 trillion in Bitcoin settled transactions. And you can see this little faint line on the right side. This is Visa and their transactions. That was a little bit over $12 billion. So Bitcoin settling more transactions than Visa. Now, if that isn't a sign of things to come, I don't know what is. Obviously, different transactions in many ways. Visa being, credit card, consumer transactions, Bitcoin being more of an investment transaction, but it's a pretty big benchmark that we've seen there. A lot of transactions, $13 billion. It's a lot. Let's see what else we got. What else we got? The media. Oh, I have to talk about this too. This was a very interesting thing that happened this week. The Bored Ape Yacht Club company, who makes those ridiculous apes, JPEGs that sell for hundreds of thousands of dollars as NFTs, they released this thing called The Other Side, which was a metaverse, and they sold 55,000 assets, which was their virtual plots of land, basically, and they went up for grabs. And the company raised $285 million by selling these virtual plots of land, which is crazy. People were snapping these things up for several $1,000s and then flipping them for 3 or 4 times as much. But they did have a problem, because what happened, they were using Ethereum through OpenSea. So Ethereum was conducting these transactions. And what happened was the Ethereum fees, which tend to be, I'll show you right here. I don't know if you can see, but up in the top up here it says ETH gas, 60 GWEI. This is the amount of money or in gas that you will pay for an Ethereum transaction. So if you wanted to buy a piece of this virtual land, you would have to pay the Ethereum fee, which the miners get. So apparently these fees went absolutely parabolic and went from 60 up to several thousand. People ended up having to pay thousands of dollars in these Ethereum fees, and the whole network just came to a standstill. Some people actually lost their money because the transactions failed. That's one of the problems with Ethereum that they're trying to sort out right now. But apparently there was $175 million in gas fees that were either lost or paid during this sellout of these 55,000 pieces of virtual land. I mean, you can see it here, burned up $175 million in gas fees, as an overwhelming number of buy requests could not be confirmed. So yes, the NFT saga continues as people pay crazy amounts of money for these virtual land plots in the metaverse, and Bored Ape Yacht Club has managed to secure hundreds of millions of dollars for themselves in the meantime. So I thought that was really interesting. I'm not an NFT buyer. I don't really understand it, and it's not something I could really see necessarily getting behind, but people are making a lot of money on these as we wait for the Ethereum 2.0 to be rolled out, which is supposed to solve all of these problems. They're saying, you know, it's supposed to be this year. I don't think it'll come out until 2023. But yeah, that is it. That's what I got for you. How long have we been going for? 52 minutes. Let's see if I have any interesting comments. Amazon loss was down to its write down of Rivian. Shares dropped on earnings predictions, not losses. Certainly, the stock market didn't like it. Star Platinum says, perfect time to continue to DCA, dollar cost average for his long-term investors. Absolutely agree. If you're a long-term investor, I wouldn't change a thing. Carful, you wanted a question answered. Is there a UK version of the Manorino Index, the MRI, or modified MMRI? I don't think so. No, not that I know of. I still say that whatever the US is doing, the UK will follow when it comes to stocks. So if you keep an eye on that MMRI, the MRI, then I think you'll be somewhat the same in the UK. Hopefully you'll get to watch that on catch up. I don't always see the comments. I don't have them up on screen when I'm doing the screen share, so didn't get to it. UK has a purchasing managers index, which has a slight improvement today. Is that the same thing? I believe it is. Need to look at the specialist REITs, which hold assets that are affected by economy so much: warehouses, supermarkets, health, and infrastructure. Infantino is the bold one. That's what I figured. When is the projected release date for ETH2? Probably next year. What was my worst crypto buy? Oh yeah, shoot. My worst crypto buy. Let me show you what my worst crypto buy was. I know I put that in the description. This one is embarrassing. I'm almost embarrassed to show you how bad this has been. Let me pull up the chart. I think this is it. Let me just check. Let me double check. Brum, 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 brum. Okay. Show me everything. Show me the money. Which one? Oh God. Yeah, so this is I don't like to even look at this. It makes me feel sick. This is my worst crypto investment. The graph. I had high hopes for the graph. I really did. If we look at the chart here, right now it's about 31 cents. I think I bought in around to, where was I? What did I buy in? I think it was around $1.20. Beginning of the year. Yeah, maybe around here. Thing went up to 225. I was getting excited. I thought, yes, yes. And then we see this crash down to 31 cents. So I think I'm at an 82% loss. Again, thankful I didn't bet the farm on this. It was a little bit bigger than most of my other, positions in crypto. Certainly very tiny compared to Bitcoin and Ethereum, but it was a decent amount that I had in there. And yeah, it didn't do well. So embarrassed. I'm embarrassed to show you that. But hey, transparent, right? So don't buy the graph. Well, actually, maybe the graph is a good buy right now. Yeah, so that's what I think about REITs. I don't know, which ones are going to do well and which ones aren't. I think Mike makes a good point. If you can find something that's recession-proof, find a specialist REIT. But again, you're taking a risk that you bet on the wrong horse. That horse doesn't make it to the finish line, and you lag behind the indexes. That's the risky thing about REITs. Maybe you can find a REIT tracker and bet that way, but I don't know. REITs, not necessarily for me, but I understand why people want them to have that exposure to real estate or property. Personally, I think probably the best way is just to try to get yourself a rental house and have exposure to real estate that way if you can get it for the right price. That's also a tough thing to do right now, but I would wait because I think those real estate prices are going to soften. Anyway, I hope you enjoyed the content tonight. Hit that thumbs up if you haven't already. And we'll be back on Thursday for another amazingly entertaining peer-to-peer lending stream. And I don't know what we're going to talk about because I usually figure out the day of. Yeah, so I hope you enjoyed it. Have a good couple of days in between. And I will see you on Thursday. Appreciate each and every one of you. I'll see you soon. Take care. Bye.